Hi. A few days ago, we did a live session on the performance of our currency, the ringgit, and why it is falling. And the feedback that we've gotten from our viewers is that the quality was pretty poor and they couldn't hear clearly. And I think the graphics were also not very clear. So what we want to do is to re-record what I've said. I mean, not word for word, but generally on the same topic as to why the ringgit has been falling, what is happening to the ringgit, but what is the longer term outlook for the ringgit. So if you recall, I mentioned that you need to look at the performance of any currency, not just the ringgit, whether it's US dollar, Sing dollar, and so on, from two different angles. The first perspective is from a short-term cyclical point of view, and the other angle you can look at is from a structural long-term perspective. These are crucial because the shorter term versus the longer term, they got different factors causing a currency, causing an exchange rate to move in a certain way, and there are different uh, implications for the economic policies of a country. So if you look at, say, the last 2 3 years, where the US dollar has strengthened a lot against most currencies, the ringgit, the yen, the euro, and so on, that is more of a short-term type of movement, and essentially it is due to the interest rate differential between America and most other countries. The American economy overheated, is still overheating, and that is why the US Federal Reserve has very aggressively tightened its monetary policy, not just in terms of increasing its interest rate, but also in terms of quantitative tightening, which is shrinking the balance sheet of the Federal Reserve. So with these two, you find that the Federal Reserve has conducted one of the most aggressive tightening the American economy has seen in a very long time. So from about March, April 2022 to now, the US Federal Reserve has increased its policy rate by 500 basis points, and looks like there are more to come. Whereas if you compare it with, say, Malaysia, in that same space, our OPR, which is our official policy rate, the overnight policy rate, went up from about 1.75 to about 3+%. And at the 2 years ago, 3 years ago, interest rate for ringgit was higher than US because US was at almost zero. Then, because of the aggressive tightening by the US Federal Reserve, there is now the reverse. The interest rate for ringgit is much lower than the US. In fact, the interest rate differential between ringgit and the US is even wider than in 2008. So this interest rate differential is not affecting only the ringgit, it affects many other currencies, and that is one reason why you could say the ringgit weakened, or you could say the US dollar strengthened. They are both two sides of the same coin. Nevertheless, this is a cyclical, shorter term type of trend. Why? Because the interest rate differential cannot stay like that for forever. And the US monetary policy cannot be so tight forever. By the time the US economy slows down, gets into recession, then the US interest rate cycle would reverse, and your interest rate differential may reverse again. So that is why for this shorter term type of thing, usually, not always, usually is linked to interest rate differential, which is usually linked to differences in inflation rates, right? So for the shorter term cyclical type of trends, I'm not particularly concerned because they would tend to reverse itself. If you look at the more developed type of economies, let's say for example Euro versus USD or AUD versus USD, you find that they move up in a cyclical way, up and down, up and down. But for us in Malaysia, and with regards to ringgit, the thing that concerns me is more the structural long-term trend of the ringgit. So if you consider, let's say, we take a few countries, we take India, Thailand, Indonesia, Malaysia, and Singapore. These are all developing countries. You may say that Singapore, even though it's supposed to be having a very high level of GDP per capita, it's still not considered a developed economy. So if you look at these 5 countries and learn from the experience of the strength of the Singapore dollar versus the weaknesses of the ringgit, the rupee, the rupiah, and the Thai baht, then you begin to understand what are the factors that affect the long-term trend of a currency, what are the policy implications, and what a country can or should do, right? So first thing is you look at current account. Current account is including the trade balance, export minus import, plus the funds and capital inflow and outflow, the short-term portfolio, the FDI, and so on, right? So in the case of Singapore, uh, it has experienced current account surplus for a very long time. If I can remember, I think for the last 40, 50 years. And not only is it in the current account surplus, but the current account surplus as a percentage of GDP is consistently high. Then if you look at the current account surplus of India, it's the opposite. It's the last 40, 50 years is, I think, 95% of the time it is in deficit, and the deficit is uh, pretty substantial as a percentage of GDP. The same thing can also be seen in Thailand, Indonesia, and Malaysia. Now, Singapore is on the one side where you got constant surplus. India is on the other side where you got constant deficit. In between with Malaysia, Singapore, Malaysia, Thailand, and Indonesia, right? So if you look at India and Singapore, Singapore's currency has been appreciating against the US dollar even in the last 2 years. Even when the US dollar is so strong, Singapore dollar is able to maintain its strength. On the other side is the Indian rupee. Remember, perpetual current account deficit, and the Indian rupee since late 70s, early 80s, Indian rupee has been weakening every year. It used to be like, let's say for example, 1 rupee to $1, for example, right? 40, 50 years ago. Now it's about 8, 9 rupees to $1. So the two extremes, current account surplus, constant, current account deficit, very constant, currency depreciating non-stop, currency both appreciate. In between, Malaysia, Thailand, Indonesia were having current account deficit before 1997. All the 3 countries were having current account deficit. Malaysia's current account deficit among the 3 countries was horrible. Malaysia's current account deficit in the mid-80s and before the Asian crisis was at times double digit. That means about 10% of GDP. That is a very serious level of deficit. Thailand also deficit, Indonesia also deficit, but lower than Malaysia. Then when the Asian crisis hit, the entire region, we were forced, Malaysia, Singapore, and so on, were forced to cut down on imports because a lot of the current account deficit was used to import a lot of equipment, machinery that were not put into productive use. Just to give you a simple example of MAS, for those of you who have forgotten, in the 90s, MAS was expanding very aggressively. It was like going to be one of the largest airlines, in the region. Keep on expanding, keep on buying new planes. And then what happened to the planes? The planes were not used to generate traffic. It was not used to generate revenue. You import, each plane is like hundreds of millions of dollars, and then after that you have to pay. You have to pay US dollars. Then you don't use it productively, and you don't have export revenue to pay back whatever you have purchased. These are things that can lead to current account deficit, right? So in the mid 80s and the mid 90s, Malaysia's current account deficit in Southeast Asia was easily among the worst. And then after that, we had to stop because you're not in a position to do this type of unproductive, nonsensical, I call it white elephant projects, like our heavy industrialization. We built HICOM, we built Perwaja Steel, we have Kedah Cement, all failed. And then the other nonsensical white elephants of the fourth prime minister. So all had to stop, not because the fourth prime minister became wiser, but economic circumstances forced the country to stop importing this type of nonsensical imports. Then, of course, your current account position will improve. It went into surplus, right? Same thing for Thailand, same thing for Indonesia. And then by 0304, I think Badawi came in 0304, right? He did the correct thing. He stopped all this type of negative infrastructure projects, and our current account surplus went up even higher. Then the same thing happened to other countries. So from 1997, 1998, Rupiah, Ringgit, and the Baht all appreciated. But in the case of Ringgit, we couldn't because the fourth prime minister did one of the stupidest things is to impose capital control. So some Malaysians will think that he did the right thing because he claims to be always doing the right thing. Capital control was, it made the ringgit a pariah currency in the world. Nobody wanted the ringgit because of capital control. So the point that I want to make is that the current account deficit, or current account position from after 1998, all the three countries improved. Singapore, of course, was still in a huge surplus. Then, in the case of Malaysia, by 2012, 2013, around that time, our current account was still in surplus. I think 2015, sorry. 2015 onwards was still in surplus, but as a percentage of GDP, it has dropped dramatically. From 10, 12% of GDP, it dropped to, I think, about 1, 2% of GDP. That is still a surplus, but the margin is very narrow because you can move into a deficit quite easily. So a lot of people don't realize that when Badawi lifted capital control in 2005, end of 2005, our ringgit actually appreciated against the US dollar from 380 to about 293 until it appreciated until about 2012, until the next prime minister and so on. Then they started a different type of economic policy again. So in the case of Indonesia and Thailand, their current account position was better than Malaysia. Thailand, in that 98 up to 2021. There were 1 or 2 years where it went to deficit, but short one and small one, like maybe 0.5%, 1%, and then most of the time it was in surplus, and the surplus was better than Malaysia. It was like 4%, 5% of GDP, right? So even though from 2014 Thailand had political instability which was worse than Malaysia, the Thai baht was able to appreciate because it had strong economic fundamentals. Even though India has political stability since Narendra Modi has been prime minister for Modi is like prime minister for forever, for life, you know. So even though India has got political stability, the Indian rupee did not benefit because India's economic fundamentals are actually very weak. For example, perpetual current account deficit. So this factor of current account surplus or deficit is one of the most important factors for especially a developing country, right? In terms of determining the long-term direction of the exchange rate of the currency. And in the case of Malaysia, I think I'm not sure what the current government, the future governments would do, whether we would be able to improve our current account position. Linked to current account is foreign direct investment, FDI. Again, you look at the 5 countries, Singapore has always received a lot of FDI. As a percentage of GDP, it is, if I were to show you a chart, which I hope my colleagues will show you the chart, FDI as a percentage of GDP, Singapore is like that. Malaysia, Thailand, Indonesia, India is like that. We are like maybe 1-2% of GDP. Singapore is like 5, 10, 15% of GDP. So this inflows of direct investment, this is not portfolio. Portfolio investment means the money goes into the stock market. This is a direct investment that goes into factories, businesses, IT equipment, and so on. So when you have such high level of FDI, it definitely benefits your current account position. So it's not coincidence that Singapore's FDI is so strong and the other 4 countries are so weak. And it's not coincidence that Singapore dollar is strong and the other currencies are weak against whichever one you want to measure. I mean, in the case of Ringgit, we are not just weak against the US dollar, we are also weak against the Sing dollar, right? Then the other factor that would affect the long-term directions of developing currency of a developing country is budget deficit. And again, at the top is Singapore that constantly has budget surplus. It's only in 2020, 2021, when the pandemic hit every country, that Singapore went into a short deficit of about 2 years. Other than that, Singapore's budget is always in a surplus. Malaysia's budget is always in a deficit. Maybe for 1 or 2 years in a surplus by luck. But most of the time, when deficit. In fact, in the 80s and the other periods, our budget deficit was at a very disastrous level. Again, it goes back to, if you look at the long-term trend, the structural factors affecting the ringgit, in fact, I would say a lot of them go back to the 4th Prime Minister, to the wrong economic policies that the 4th Prime Minister implemented. The budget deficit in the 80s was mainly due to very aggressive implementation of the new economic policy. The government was, because in the 70s Malaysia had a boom, a commodities boom, rubber price went up, all-time high tin price, palm oil price, timber price. Malaysia's economy was agri-based, boomed like crazy. So at the same time, the government was implementing the new economic policy and nationalizing a lot of things and spending a lot of things on the so-called achieving the NEP. And we went into huge budget deficit. if you have budget deficit, current account deficit, you're heading for a disaster. Most Malaysians, in fact, I think 99% of Malaysians do not realize that in the mid-80s, in 1985, 1986, when the Malaysian economy really suffered its worst ever economic contraction. Our unemployment rate went up to as high as about 8-9%. Now the unemployment rate is about 3-odd%. At that time it was 8-9%. And one of the things that the fourth Prime Minister did in the mid-80s, 85, 86, was to depreciate the ringgit. The ringgit plunged by 30-40%, but nobody talks about it. Only people talk about 1997, as if that's the only time when we have a currency crisis. So, look back, why? We had huge budget deficit, huge current account deficit, hardly any direct investment flow into Malaysia. So, at that time, the government had to let the ringgit, before in the 70s, ringgit was against Sing dollar, a dollar to a dollar. Because of the crisis, we had to devalue our currency. We have to relax our NEP, our Industrial Coordination Act, which was an act introduced by the Malaysian government as a way of achieving NEP. So you need to have licenses to be a manufacturer and so on. So they relax the conditions in that act and let the ringgit become more competitive. That attracted a lot of FDI. Then Malaysia was able to recover from that. But the ringgit had to go down. So I was talking about budget deficit. So in the case of Malaysia, the history is always budget deficit. Same thing for Indonesia, except that it is not, as a percentage of GDP, it's not as bad as Malaysia. India also perpetual budget deficit, as a percentage of GDP is also at a high level. Thailand, also budget deficit, but not as bad as Malaysia. So if you look at the 5 countries, the one that has the strongest currency has got constant budget surplus. The other 4 has got constant budget deficit. And as I mentioned, out of the Malaysia, Indonesia, Thailand and India, Malaysia's budget deficit was among the worst, right? So it is, if you look at it from the longer term, it's got nothing to do with interest rate differential. And if you take all these factors, these long-term factors into account, Malaysia's budget deficit is going to continue because we still haven't been able to find more efficient ways of getting extra revenue. We still keep spending a lot in terms of government spending, whether it's in the form of subsidies or whether it's in the form of emoluments to civil servants. I'm not sure how, whichever the government is going to tackle this budget deficit. Current account, we still are at a slight surplus, but we've got to watch it carefully. And to tackle that, I think we need to also make sure Malaysia remains a lot more attractive, a lot more competitive in pulling in FDI. Because once you pull in FDI, especially FDI, there are so many types. You have the type of FDI that leads to a poor, good economic growth, but bad economic development. Or the type of FDI that will give you maybe not such a impressive GDP growth, not like 7-8%, but good quality economic development, where you focus a lot more on quality, right? So the difference, for example, you have economic policy whereby you need another 1 million low-wage, low-skill foreign workers. Now your GDP figure will look good, but economic development is forgotten. I may have the other one. Instead of 1 million low-skill foreign workers, I may have, say, 10,000 global talents. High wages, global talent. Your GDP growth will not be 7-8%. It may be 3%. But you have good quality economic development where you're able to move up in terms of maybe advanced manufacturing or more sophisticated type of services. That is what the FDI should attract. Don't just keep attracting FDI for the sake of FDI, because there can be wrong FDI. So can we do that? Then it comes back to whether we have the workers, whether Malaysian workers are skilled enough, whether we have enough of them to be able to attract the quality FDI. That is another long-term problem. So I'm not saying that the present government is only in the government for only about 100, 120, 130 days. There's not enough time to tackle these structural problems yet. But whichever the government is, must look into these factors, because if the government does not address the long-term structural defects, the ringgit is going to be jalan sehala for a long, long time to come. Right? And the other thing is the inflation side. Inflation, if you look at it again, there's the mixed bag. India's inflation is among the worst. Malaysia is because there's a lot of subsidies, a lot of price control. So inflation can be a short-term and a long-term factor. If you cannot get your inflation under control over long periods of time, then it becomes a structural reason to drive the exchange rate of a currency. But if your inflation cycles are, cyclical type, it goes up and down, then your exchange rate will be reflecting that as well. So inflation in the case of Malaysia, among the various factors that I mentioned, I think the serious one will be the budget deficit, the FDI. To need to get those, effectively address those issues, then maybe, who knows, 5 years from now, 10 years from now, we can see the ringgit strengthening. But because I expect the US Federal Reserve to continue increasing the interest rates, the US economy is still overheated, and the gap, the interest rate differential between, say, for example, the ringgit and the US dollar may even widen further. So from a shorter term point of view, the ringgit will still be under pressure. But the longer term trend is the one that concerns me the most, because that's the most damaging and that's the most difficult to deal with. I hope that helps. Exchange rate determination is one of the most complex subjects in economics. There are two very complicated topics in macroeconomics: inflation and exchange rate. Right? I have tried to explain it in a simpler term. I don't want to use theoretical approaches because it doesn't apply to every country. If you look at the reality, currencies of developing countries are treated differently from currencies of developed countries. A developed country may have current account deficit for a long period, but doesn't get subjected to devaluation pressure because the perception is different. And the rating agencies, the global rating agencies, also look at it differently. Right? The same problem, current account deficit, one that's faced by developing countries, one that's faced by developed countries, will get different treatment. So I give you the 5 countries, are all, including Singapore, are also called developing countries, whether high income or low income. Right? So I hope that the quality of this recording is a lot better than the one that we did in the live session. Anyway, I welcome your comments, your feedback, and like I said, I try to make it as simple as possible so that you can see the key factors involved in an exchange rate determination. And follow us all the time, and thank you very much for listening.